point number 3. Let's move on. Okay, so we're clear.
3.
We've done point number 1, point number 2. Let's
point
do
number
3.
3. So cash flow is just gravy. Someone just said that on a forum the other day that I was reading, and everyone's like, amen. And I'm like, heck no. Let me tell you. We started our investing 18 years ago on that basis. We'd been taught that from our, mentors. Cash flow is gravy. Great. What you really want is market appreciation. That's where the real money is. That's when you're making $100,000 in a year or whatever it is. Guess what? That almost sunk us, and it has sunk countless investors.
Okay.
Cash flow is not gravy. Cash flow is dinner. You need cash flow to survive. You cannot survive on gravy or dessert or whatever you want to call it. Okay? Cash flow is important. If you're in a market that is going up exponentially, that's awesome. I'm happy for you. But guess what? So are we. And guess what? It stops. And we've seen in the last 18 years that no matter what market you're in, does not matter the city you're in, the market, the area, the natural real estate cycle, the economics are not, it's a science. It's gonna hit, it's gonna go down. That's just life. If you're not cash flowing those properties and you don't time the market perfectly right, you're gonna lose your shirt.
Yeah. So just to clarify here, in my opinion, appreciation is the real wealth maker. Absolutely. That's where you're really going to make wealth. When your properties go up in value, when you buy in a market where properties go up in value, your mortgage gets paid down. That's where the big lump sums come from.
But not fast appreciation.
The key in what Tiffany is talking about, and where, cash flow is not that important. Don't worry about it. It's gravy. That is so true, because if you don't have that cash flow, let's say COVID hits and rents go down in your particular market, and now you're negative cash flow, and let's say you're a successful real estate investor and you've bought in 5 to 10 properties, and now they're all $500 a month negative cash flow, that's a big chunk of money, and that sinks people. So when you're buying property, do you need to make sure they cash flow? Absolutely. Is that where you're going to make the biggest chunk of money in real estate? No. You're going to make the biggest chunk of money in real estate when it goes up in value and your mortgage gets paid down.
Over time or quickly, doesn't matter.
The cash flow keeps you in long enough, and that's really the key to all of that.
So that's at the end of the day what we've seen. We have seen more investors come and go in our 18 years. They do so great. They build their portfolios quickly. They buy. They do so good. And 5 years down the road, they're no longer in the game. And they're back to their 9-to-5 jobs, and they're back to, not living the life of their dreams, because they bought based on equity appreciation. And that appreciation is awesome when it's there.
Well, we did too, right?
We did too.
Yeah.
We were one of those casualties of it, but for some reason we're still standing, and we were able to work through that. But let me tell you, we bought on the fact that, it's just minus $50 a month. We can handle that. We've got another business. It pays for it. It's not a big deal. It's just minus $50. It's just minus $100. It's just minus 50. It's just break even. Well, guess what? When you get to having 25 of those properties and then the market stalls, you're in trouble. You're now paying out of pocket every month to support this portfolio. We've done it. But we've also seen many who have done it that didn't make it through.
Yeah.
And that's what we're talking about, guys. If you want to be successful, and this is for those of you guys, Simon and Melanie and all you guys that are around, have been with us for a long time, we preach big time about staying long in the market. Your mortgage has to get paid down by your tenants. The market has to naturally appreciate, maybe fast, maybe slow. You have to give time for those things to happen. So if you're not cash flowing, guess what? You will be stressed out beyond words. Every vacancy, every scratch on the wall that your tenants make, every repair that comes up, you will be stressed out, and you will quit this game far before wealth actually kicks in. So what's the absolute deal? Cash flow is not gravy. It's bread and butter. You have to be cash flowing. It doesn't have to be a ton. You have to be cash flowing in order to last in this game, because you need to last those years in order to really hit wealth.
And I would suggest if you're ever looking at a property, and right now, guys, the market is in most parts of Canada, most parts of the world, the market has dropped, it's dipped a little bit, it's struggling a little bit. If you're able to cash flow in the market that we're in now, of course, there's markets that are doing phenomenal, so don't get me wrong. But if you're in a struggling market and you're able to cash flow now, Sam made a good point. Imagine when the market comes back. Imagine when the things go up. You're going to cash flow dramatically. So that's the key. If you can cash flow, just make sure you are. Make sure you can at least survive that cash flow going down 10 to 20%. If your rents dip 10 to 20%,
or you get a vacancy
and you can still cash flow, or exactly, then you're going to be you're most likely going to be much safer in that scenario. So very important point. Make sure that you cash flow. That's what keeps you in long term. That's what enables you to be there long enough for that property to go up in value. Remember, it's not about making money off of that cash flow necessarily. It's about enabling you to stay in long enough. That's the important part.
And why does cash flow help you do that? Is because it keeps the emotions out. And as investors, it's real tough to keep your emotions out when you've got, $2,000 payment coming out of your bank account and no rent coming in that month. And that means you have to work later, longer, skip a vacation, take from your kids' school funds, whatever it might be. That's where things hit you, emotion kicks in, and that's where we really see people drop out. And when you drop out of real estate too soon, you really lose out because it's in the long term that things kick in.